Let's talk about how to avoid paying capital gains tax. And yes, I mean literally. Not defer it, not reduce it, avoid it legally. Because thanks to a combination of long-standing tax rules, new legislation, and a little bit of smart planning, there are multiple ways you can sell appreciated assets and pay $0 in capital gains tax. I'm going to walk you through how this works, especially under the newly passed Big Beautiful Bill, and also explain why strategies like stepped up tax basis and 1031 exchanges can make this possible not just for you, but for your heirs as well. Let's start with what might be the best kept secret in the tax code, the 0% capital gains tax bracket. Here's how it works. For 2025, if your taxable income is less than $48,350 as a single filer or $96,700 for married couples filing jointly, then your long-term capital gains tax rate is 0%. So if you own appreciated stock, a brokerage account, mutual funds, or other investments, and you sell them while your taxable income is under those limits, you could owe nothing in federal capital gains tax. Now, thanks to the recent Big Beautiful Bill, this opportunity has expanded. The bill increases the standard deduction, added a $6,000 senior deduction, and introduced other favorable income adjustments that will allow more people to qualify for that 0% bracket, especially retirees, early retirees, and people in temporary low income years. That means that this is the perfect time to talk about tax gain harvesting. Tax gain harvesting is the exact opposite of tax loss harvesting. Instead of selling your losing investments to claim a deduction, you sell your winning investments strategically during years when you're in the 0% capital gains tax bracket. So why is that? Well, because you lock in your profits now, you reset your cost basis higher, you reduce future capital gains tax liability, and you pay zero tax on the gain today. Let's say you bought an index fund for $50,000. It's now worth $90,000. You sell it while your taxable income is below the threshold, no tax. Then you buy it back immediately. Your new basis is now $90,000. If you sell it again later at, say, $110,000, you only owe tax on the $20,000 gain, not the $60,000 gain you would have had without resetting the basis. This strategy is especially useful for retirees, folks between jobs, people taking a sabbatical, if you will, or anyone in a low-income gap year. Now, let's talk about what happens when you die, and I mean that in a helpful way. Under current law, when someone passes away owning appreciated assets like stock, real estate, or business, the heirs receive those assets with a stepped-up basis. That means the tax basis gets reset to the asset's fair market value as of the date of death. If your dad bought a rental home for $100,000 in 1980 and it's worth $750,000 today, your basis when you inherit it is $750,000. You can sell it immediately and owe no capital gains tax. It's not a loophole, that's just the federal tax law. And it's one of the most powerful estate planning tools available, especially when paired with deferral strategies. Now, if you've watched my videos before, you've probably heard me say it, but I'll say it again. 1031 exchanges are your friend. They let you sell investment real estate and roll the entire gain into a new property without paying capital gains tax on the time of the sale. It is a deferral strategy. And here's the kicker. You can keep exchanging again and again, deferring the capital gains tax essentially indefinitely with a little cooling off period in between exchanges. But when you pass away, your heirs get a step up in basis, wiping out all those deferred taxes. This is how real estate families build generational wealth. You've got a property worth $1 million that you bought for $200,000. You exchange it into a $1.2 million property. Then a $1.5 million property. Extreme numbers, but the point still stands. Over time, you are deferring 6 figures in taxes. Then you pass away, the value resets, and your kids inherit it tax-free at the new market value. Now, I've done a few deep dive videos on 1031 exchanges already, so if that's something you want to pursue, go check out one of those right after this one. Here's where it all comes together though. Use tax gain harvesting during low-income years to reset your basis. Use 1031 exchanges to defer taxes on appreciated real estate. Let your heirs benefit from the step-up in basis to eliminate taxes altogether and qualify for the 0% capital gains bracket when your income allows it. It might sound a little shady, but it's not aggressive tax dodging. These are IRS-sanctioned strategies that smart investors and planners are using right now, especially under the enhanced rules in the Big Beautiful Bill. Capital gains tax does not have to be inevitable. If you plan early, understand the rules, and take advantage of what the law allows, you can avoid paying it now, or maybe even ever again. But with that, I'm attorney Andrew Bethel. If you've got questions about capital gains, tax planning, or how to make sure your estate passes as efficiently and tax-free as possible, reach out to our office or leave a comment down below. And don't forget to check out our videos on 1031 exchanges and our other tax strategies. While you're doing so, don't forget to subscribe, ring the bell, like the video, you know what to do. Thanks for watching, and I'll see you at our next meeting.